In our last lesson, we finished looking, we first had looked at calculating PAYE, and we had looked at comparing household and business taxes and the difference between. I'm not satisfied with that being the end of our studies on tax. I think there should be more. So I've just added a small bit here. Some of this obviously won't be, well, just this slide really won't be in any book because obviously this is a slide to do with COVID-19 and it's all happened the last 12 months. But I feel like this is going to be quite relevant in the uh, upcoming leaving certs, so for the next couple of years. So there's been some slight changes due to COVID-19 for tax. So the hospitality rate has gone from 13.5% to 9%. You generally, for some things, you're not expected to know tax rates. Sometimes they'll tell you, but for others, you might be. So this is something that's just happened in the last, I would say, 4 months. What does it mean? So obviously, the hospitality sector is not to do with hospitals. Hospitality sector is to do with anyone who's kind of catering for other people, from hotels to restaurants to bars. So we're looking at basically bars, restaurants, and hotels, that kind of thing. That's our hospitality that we're looking for. And their VAT tax rate got from 13.5% to 9%. Basically, they're paying less tax, and obviously this is an initiative set up because those bars, restaurants, and hotels are the very businesses that are very much struggling in the past 12 months because obviously of all the lockdowns. So they've reduced the tax rate that these businesses have to pay so that they can save some of their income and not hand an additional 4.5% to the government for tax. So that's reduced hospitality VAT tax. Again, it has to do with the likes of hotels, restaurants, and pubs. New social welfare payment for job losses from COVID-19 is not the COVID payment, is the pandemic unemployment payment. I feel like that will show up for the next couple of years in short questions. So the social welfare payment for job losses from COVID-19, that whole COVID payment, the 350 early on that people were signing up for, is not called the COVID payment. It is the pandemic unemployment payment, the PUP. So I'm actually just going to fire in PUP here as well, because that is the way it most likely will be phrased in an exam. What is the PUP payment? So the economic effects of COVID-19, just a couple of things to add in from an economic standpoint, because sometimes this can be a follow-up question to tax. Obviously, what happened to people over the course of the last 12 months? Well, a lot of people would have less income tax. A lot of people are paying less income tax, basically, because there's a lot of people that lost their jobs. There's a lot of businesses that have been temporarily shut down. There's a lot of businesses that have been forcibly shut down, and obviously all those employees are no longer earning. And if they're not earning, they're not paying income tax. If somebody was earning 60,000 in a year, they might have been paying, maybe 20,000 euro of tax, and now they're not earning 60,000. They're not coming anywhere close to it. They're not coming anywhere close to paying 20,000 in income tax. So there's obviously been less income tax for the government to spend. There's been less public spending by obviously the consumers. People haven't been buying as much. People haven't been traveling as much. Instead of going away for tourists coming here and spending money, or people going around the country to go to places, going to festivals, going to different random events, there's a lot less spending because all of that was cancelled. So obviously, if the public's spending less, the big hit to the government is going to come from the fact that they've also received less money from income tax. There's less public spending, and now they've had to increase their social payments. So their social welfare payments have majorly increased. Job seekers allowance has gone up. Obviously, the unemployment rate has gone up. There's more people unemployed. And they also had to introduce the pandemic unemployment payment, which was a vast figure. I believe it's about 2 or 3 billion additional debt in the first couple of months of the first lockdown into the second one, I think. I'd say probably just the first lockdown, you could be looking at a couple of billion extra debt added on to the Irish deficit. So obviously from a from every standpoint, COVID-19 has been a complete disaster. Getting started with income tax. So what I'm going to finish this with here is, because we've looked at the theory to do with tax, but I have to still go through how we calculate paying tax. So a couple of different things. And for anyone here who's had a part-time job, if you've been working in a shop or a waiter, waitress, anything like that, when you initially sign up and when you are being paid initially, you will be emergency taxed. It is in your best interest to get this sorted quickly so that you get your money back. Emergency tax is a very, very high rate of tax. It's higher than the normal rate of tax. You literally lose half your income. And it's when you start a new job. It's designed to encourage new employees to get their tax affairs in order as quickly as possible. Basically, the revenue commissioners want you to tell them when you start the new job. But realistically, very few people are that organized that they're going to be ringing the revenue commissioner every time they change their job. So the revenue commissioners obviously will feel like it's a complete disaster if they're not able to track where people are working, to find out how much tax people are paying. So in order to keep track of it, they have just basically charged you an obscene amount of tax, emergency tax, whenever you start a new job. So whenever your paycheck comes in from a new employer, there's an emergency tax put on it. And obviously it's going to be not going to take too long for you to realize that you are losing half of your income, and you're going to ring revenue to sort it out. Basically, you're going to end up informing them that you've started a new job. They'll want to know details of your new job, and then they'll give you all that emergency tax back. So you receive it all back. And obviously at the start you'll lose about half your paycheck, and then you get that money back. So it's a higher than normal rate of tax, designed to encourage new employees to get their tax affairs in order as quickly as possible. Income tax rate. So the income tax rate basically is our PAYE. It's a pay as you earn tax, a progressive tax. It's a percentage of tax that is levied on a person's income. So obviously it's tax paid on your income, but it's by percent. So there's two different rates. In Ireland there's two different rates. Other countries like France there's three. The different rates, the standard rate currently is 20%, and the higher rate is currently 40%. Sometimes these change. So we'll be looking at this soon. So the standard rate, which is just sometimes called the lower rate, is 20%, and the higher rate is 40%. What does all that mean? Well, this slide will explain it a little bit more. We have the standard rate cutoff point, the SRCOP. The standard rate cutoff point is the amount of income that will be taxed at the standard rate. The standard rate cutoff point has been 35,300 since 2019, and I had to go back and check that, because generally you're on the budget every year. They might change that figure small, but in previous years it was as low as 33,000, but I think about 10 years ago it was about 39,000, so that generally does change quite a bit. What does that mean? So if I had a job and I was earning 20,000 euro, my 20,000 is obviously less than this 35,300. So this is a cutoff point. It's basically just a figure that we just use to kind of decide who earns more than this and who earns less than this. So there'll be different rates of tax. If I earn 20,000 euro, I'm obviously earning less than the standard rate cutoff point. So because I'm earning less than that, all of my income will be taxed at 20%. I'm earning 20,000 euro, all of it will be taxed at 20%. If I earn 40,000 euro and I double my income, now my income is bigger than the standard rate cutoff point. It's bigger by 4,700. So my income is now 40,000. The first 35,300 of my income will be taxed at the lower rate, 20%. So everything from 0 up to the standard rate cutoff point is going to be taxed at 20%. And everything thereafter, everything beyond 35,300, so that additional 4,700 on top of that I've earned, is going to be taxed at the higher rate of 40%. So obviously as you earn more money, especially as you get into the higher figure of earnings, your tax is going to increase. So standard rate cutoff point is 35,300. Basically, every bit of your earnings below that is taxed at 20%. Every bit of your earnings above that is taxed at 40%. We'll be looking at an example in a second. Tax credit is the amount by which a person's annual bill may be reduced. It varies from person to person depending on the circumstances. So it depends on loads of circumstances. For example, if you're single, if you're married, certain disability allowances and things like that. Tax credit is basically a kind of just, I suppose it's a case of you owe a certain amount of money of tax to the government and they give you this credit, which is basically money off. So if I owe €10,000 to the government at the end of the year, that's my tax that I owe, and I had a tax credit of 2,000, well, I'm not going to be paying that €10,000 in tax. I'll only have to pay 8,000 in the long run. So a tax credit basically reduces your tax bill. It's the amount by which a person's annual tax bill may be reduced. There is no set figure, it depends on circumstances, and then it's calculated. Gross pay is pay before all deductions. So gross pay is basically the money that you take in. Your basic pay for working whatever hours and whatever much you earn per hour, plus your overtime, plus any bonuses, plus commission, all adds up to your gross pay. So that's obviously your earnings. Deductions is obviously, this is money that's going to be taken away from your income. This is tax. We're looking at PAYE here, we're looking at PRSI, we're looking at universal social charge, we're looking at things like that. So deductions are all the payments that must be taken away from your income. So if my gross pay here, if my gross pay is €40,000 and my deductions are €8,000, I'm obviously going to deduct my deductions because this is my tax and stuff like that. So my gross pay is 40,000, my deductions are 8,000, and then my net pay will be 32,000. It will be the difference. It's the gross pay minus all deductions. It's called your take-home pay. That's the money that arrives in your bank account. That's the money that you physically get to spend. That's yours. Gross pay minus deductions equals net pay. So this is our example, and I'm going to talk through this, and I'm going to be assigning questions for you to do after. So John has a gross income of 60 grand. Standard rate cutoff point is 35,300. So this is basically what John earns. This is his income. This is the standard rate cutoff point. The lower rate of tax is 20%. The higher rate is 40%. Again, that's that's standard. PRSI is an additional tax. It's 4%, and tax credits is 7,500. I know that John makes €60,000 a year, but I know that if John checks his bank statements, he will not have earned €60,000. He didn't get to take all this money home. So we need to find out how much money John had to pay in tax. And what we're going to be doing is we're going to have to calculate his PAYE using these figures. We're going to have to calculate his PRSI, and then we'll have his total tax, and we'll just take away his tax credit. So John earned 60 grand. First thing I'm going to do here is calculate how much his PAYE is going to be. So I've done some of this up at the top line. So we're looking at the standard rate cutoff point. So the standard rate cutoff point is 35,300. John's income is above that. So the first 35,300 that John earns will be taxed at 20%. So his first 35,300 that he earns, he'll probably earn that from January to July sometime. His first 35,300 that he earns will be taxed at 20%. So how do I calculate his tax for the lower standard rate of tax? 35,300 by 20%, and that gives you 7,060. But John doesn't earn 35,300. He goes beyond that, and he earns another 60 grand. So he earns an additional 24,700. How do we calculate anything above the standard rate cutoff point? Well, we move from this lower tax rate to the higher tax rate, and the higher tax rate is now 40%. So let's look at this again. The rest of his income, 24,700, everything above the standard rate cutoff point, is taxed at the higher rate, 40%. So this initial 35,300 was taxed at the lower rate. This 24,700 above that to make up 60 grand is taxed at 40%. And that gives me 9,880. And obviously you'll notice the tax rate has doubled. So even though John has more money taxed, as in he's 35,300 to be taxed at this rate, his tax is higher here because obviously the tax rate has doubled. So that's his tax at the standard rate, that's his tax at the higher rate. what's his total tax? Well, his total PAYE tax is obviously the two of them added up together. So John's PAYE tax, his income tax, is 16,940. So John, out of his 60,000 euro, he nearly loses 17 grand to PAYE. So straight away we know that he is going to obviously not take home the 60 grand. That's just PAYE. There's other things that we looked at as well. The next one is PRSI. PRSI is 4%. So how do we think we calculate that? Well, if his earnings are 60 grand, PRSI is at 4%. Quite simply, you just take that initial gross pay figure and you multiply it by 4%, giving you 2,400. So John's PAYE is 16,940 and his PRSI is 2,400. Are we done? No. We now know his income tax. We know his PRSI. So we can add those up and we can find his total tax. But we have the tax credits left, and then we have to find out how much. Obviously the two taxes are deductions, and if we take them away, gross pay minus all deductions, it's a take home pay. So but first we'll look at the tax credits as well. So going to the next slide here, we're going to find John's total tax. So it's PAYE plus PRSI. PAYE, again, we see here was 16,940, PRSI was 2,400. These are my two figures, they add up to 19,340. Next line here, we're going to be looking at his tax credits. So John has tax credits of 7,500. We deduct this from his tax owed. John owes 19,340 euro of tax before the tax credits, but his tax credits are 7,500. And if we can remember what we just looked at, tax credit is the amount by which the person's annual tax bill may be reduced. It's basically they're letting you off paying a certain amount of tax. So they are letting John off paying 7,500. So even though John's tax is 19,340, they're letting him off 7,500. So how much does he owe? What's his tax liability? It's 19,340, his total tax, minus his tax credits of 7,500 is 11,840. John earns 60 grand, his total tax is 11,840. How much money does John see coming into his bank account? What does John actually get to take home? His income is 60 grand, his tax owed 11,840. Obviously take that away. John's income is 48,160. That's the amount that John has at the very end of the year. It's the amount that he actually gets to see. It is his net pay. So I've just walked through an example there. To be honest, it does get more complicated. Usually if to do, if it was a long question, and it's a nice long question to come up, you might have additional charges like pension scheme and universal social charge, but they're all percentage based off of certain figures, and the information is usually given to you. We'll look at that in time to come, but I'm going to give you a few questions for homework to start now.